Investment Analyst reacts to finance TikToks, part 9.
Trade wars, crashing stock markets, recession concerns. Investors wander in the dark aimlessly, pleading for someone to save their gains and guide them towards the light, with but one platform rising to meet the call, the beacon to guide us through these uncertain times and answer the most important questions. Where should I put my money? I'm, of course, talking about TikTok.
Don't keep cash in the bank. Don't? No. You should never have money in the bank.
Welcome to The Plain Bagel. My name's Richard Coffin. We're back again, reviewing some finance TikToks in episode 9, I want to say, of
I think this is going to be a lot of fun. I think it's going to be a lot of fun.
Investment Analyst reviews investment TikToks. It's been a minute since we last reviewed some finance TikToks, and with there being a lot going on in terms of the global breakdown of trade relations, I figured what better time than to look for some answers online and information and advice on what people should be doing with their money during this turbulent time. Now, in the past, I know I've given my feedback on these TikToks, having worked in the industry. For those new to the channel, I'm a registered portfolio manager with my CFA and CFP designations. But I figured this time.
By the way, CFA is exceptionally hard to get, extremely hard to get. I know several people with CFAs, and they have to study and pass exams to achieve that. And they say it's the worst 2 to 3 years of their life. It's I couldn't imagine doing it. Now I have a CMA, that's a certified management accountant, right? Back in my previous life, working in corporate finance, that definitely helped me out. But at this point in my life, I'm not doing much accountancy. However, the CFA is a totally different ball game, and only a few people get that every single year. It's really tough. So he understands the markets for sure. Now, am I going to agree with everything he says? No way. But let's see what he has to say.
Time around with these uncertain times, let's take on the role of student. I have my handy dandy Microsoft Word document here. We're going to take notes and see what lessons we can garner from these TikToks in terms of what to do with our money during these uncertain times. And I'll probably still comment on a few things, but we'll keep an open mind, see what we can take away here. But without further ado, let's hop into it.
Holy shit. Okay. If you are not aware right now, 2025 is about to have so many new millionaires, and it could be you if you know what you're doing and if you take action. In 2024, if you did not learn a high paying skill, I am so sorry. I know that you feel like, damn, I can't even put into the stock market right now, because for those of us who did learn a high income skill, we are about to eat. Okay. And it's not too late. Hold on. Not too late to learn a high paying skill. I highly recommend that if you're able to, you still do it. But for those of us who have, it is time for us to start buying in the market, okay? This is going to be an amazing 2025.
Audio. Hold on. By the way, this guy is now using TradingView. I'm still getting used to it. I'm using Rick Warfish's settings here for order blocks, as well as I think the Sonar Lab or order block. Anyway, still getting used to things, so things might change on the charts right here. But as I've told you guys before, be buying stocks on the way up as they're crashing up versus crashing down, right? I don't know what this young lady's saying, but for sure, buy them as they're crashing back up, not as they're crashing down. So let's see what he has to say.
It was weird at the end there. All right, first note, start buying. Learn high-paying skill. That's about all I got from that one. Yeah, not too much to comment on that one. I'm assuming the high-paying skill is related to a course she might be selling, so be cautious with that. Yeah, no one knows how 2025 is going to pan out, I guess, is kind of the main thing I would want to touch on. Things could go lower from here. They could go higher. You do have to kind of take that longer-term approach, but keep an open mind here. So we won't comment too much on that one. We'll leave it there.
The stock market is not on sale. Do not buy on these dips. Everything that we have been taught and that we have learned and that goes through all of social media is for up markets only, normal economic times. And right now, this is not an up market, and this is an abnormal economic time. We have to stop believing in these phrases that make no sense. It's not timing the market, it's timing the market. And everything else, throw out the window. 2001, 2002, we had an overvalued stock market, and it crashed, and it pulled the economy down with it. In 2007, 2008, we had a good value stock market, but the economy crashed and pulled the stock market down with it. Now we have both at the same time. We have an overvalued stock market. The stock market is the second highest valuation in history, going into a recession. That has not happened in my generation. This is going to be bad. So all technical terms and everything of the norm, do not listen to. Go to safety, make sure you're okay, because it's going to be a wild ride. And I do believe the stocks are going to drop 50 to 60%.
Okay, so before he talks about this, this is the basis for this slide here. Hang on, where there's always a reason to not invest in the market. There's always a reason to not invest in the market, right? So this is from, looks like 2009 to 2021, right? There's always a reason not to invest in the stock market. But before I hear the plain bagels rebuttal, my opinion is there's always a great time to invest in the stock market. Always a great time. But that doesn't mean you need to be buying it as the stocks are going down, right? Wait until you see the outlier trend template confirm the direction you want to see, right? So if you are a long short trader like myself, you know how to trade in both directions. But if you're a long only trader, wait for the 10 to go over the 20 with price to go over the 50. That'll show you when the bottom is in and it's actually in a bullish trend. Does that mean it will last forever? No. AMD is a perfect example. That happened right here, 1020 over 50, and then it turned back the other direction. Okay. So even though a bullish trend started on this date, that doesn't mean it's going to continue on forever. So you obviously, absolutely need to make sure that you're always keeping your risk in check, always trading risk first. So we don't quite have the 10, 20, 50 crossed up yet, but we also don't have the aggressive acceleration to the downside. And a lot of charts are looking just like this, where they found a bottom and are starting to move up. And that's what we want to see, right? We want to see the basket of stocks moving together, not one stock on its own trying to save the market, right? You buying the one stock saying, hey, it has to go up from here, right? Now you want everything moving together. A rising tide lifts all ships, and a falling tide shows who's swimming naked. But there's always going to be a reason not to invest. My opinion is look for those opportunities. Wait in cash for proper setups as long as it takes. And that's not actually my phrase. That came from one of my mentors, Mark Minervini. Wait in cash for proper setups as long as it takes. Forget the noise and look for those opportunities when they fit your plan, right? If you're not in the markets, take the time to make a plan. I know a lot of our outliers have done exactly that. They've been sitting in cash for a minute, of completely sidestepped this move down, which has been awesome, right? Hasn't it been fantastic to have zero stress as the market is wiping out people day after day? It's been amazing, right? Now, for you, have you made that plan so that you'll know when it's time to get back in? That's the real question right now. So there's always a reason to get out, but there's always a reason to get in if you have a plan.
Do not buy, only invest in up market.
Facts. Just facts. Don't contradict me in this. Do not contradict me in this. Reason being is that let's look at AMD as example. This is facts. I know you want to be sarcastic and say that you only you need to be dollar cost averaging on the way down. But let's look at that AMD as an example. If you bought AMD at 150 thinking, oh, I'm going dollar cost averaging it. I am so smart. I'm Valley Girl Chris today. I am so smart. I'm going to invest into AMD all the way down because I want to get AMD at the very lowest price that I possibly can. So I'm gonna buy some AMD right here. She has a Louisiana twang as well. I'm gonna buy some AMD right here at 150, and then I'm gonna buy some AMD right here around 130. I'm a Valley girl from Louisiana. It's real good. I'm gonna keep on buying it all the way down. Yes, sir. That's right. So I got some at 145, 130, 115. In fact, I think I even want to get some more at 100. That's real good. Yeah. Now, the problem with this is that she is a loser. She is a loser beyond all losers because she decided to make things worse for herself. Not only did she buy here, let's see, not only did she buy here, but then she bought here and here and here. Now, it might make her feel good. It might make her feel good to see, oh, my average price is going down. But here's the crazy thing. This is so weird how math works. This is so weird how math works. But if we open a Excel workbook here and we say, okay, we bought AMD at 145, we bought AMD at 130, we bought AMD at 115, and we bought AMD at 97. Okay. So then we go average. And we do this, right? The average price of that is $121. So while she bought it at 145, and then you get 130, and then you get 115, and you get it at 97, all the way down. Oh my God, I'm so smart. I now own AMD at 120. Oh my God, isn't this so cool? The problem now is that the price of AMD is still at 97. Yikes. The price of AMD is still at 97. So let's say the Valley Girl's real smart. I'm real smart, and actually, I'm going to buy it on the way up. I'm going to buy it at 97, and then I'm going to buy it again at 115, and then at 130, and then, you know what? If things go right, I'll buy even more at 145. And here's the crazy thing, because I'm the smart Valley Girl. My average price is the same. The average price is the same if you're going to get in as it's crashing down as if you were to get in as it's crashing up. Isn't that crazy how math works? Dollar cost average my backside, okay? It's not going to work out if you're buying it all the way down because we don't know. We don't know where the bottom is. Maybe it stopped at 97, or maybe it went down even further. I don't know if my tools are going to work correctly. Actually, I have no idea how to draw an arrow on here. Let's see. Maybe instead of this is literally my first day using will this work? This is literally my first day using TradingView. I've been using TrendSpider for years. Oh, Dad, that is a big ass arrow. Maybe instead of stopping at 97, it goes all the way down to like 45, right? And then I can throw, this is a new thing I found. This is fun. And then you're going to be like, oh my God, what a great price that I just bought. Isn't this amazing? This is so stupid. Why is this in a charting program? But I love it. Point being, you don't know when the bottom is in as you're buying on the way down, but you can certainly put the outlier trend template together with the 10 over the 20, price over the 50 to know when it is going up. And of course, that doesn't mean it's always going to trend up, but it certainly is going to keep you out of the way from trending down. How do I make it go away? Remove 9 drawings. There we go. And of course, losers average losers. Okay, don't be a loser. Don't be a loser.
All right, already running into a bit of an issue here. So there are some valid concerns around valuation here, especially given that when you look at the S&P 500, the CAPE ratio is near historical all-time.
Okay. Valuation is what the price costs today. You can put whatever value, you can drop whatever numbers you want into a spreadsheet, but it means nothing. Absolutely nothing. I'm grabbing a prop over here. You know where this is going. Because only price pays. Only price pays. You can create whatever PE ratio chart you want. You can create whatever I don't even know. I don't even follow what these fundamental ratios are because it doesn't matter. The only thing that matters is if price is going up. If price is going to go up, you're going to get paid. If price is going to go down, you're going to come up with all these reasons why it should go up. And should is the absolute most dangerous word in finance. You can either be on the right side making money or be on the wrong side making excuses. That's your choice.
Highs, meaning that the gap between stock prices and their underlying earnings is fairly stretched. I don't know if calling it a 2000 plus 2008 sort of situation is fair. 2008 was more of a structural problem that we ran into, whereas this current kind of decline we're experiencing is more event-driven. And because of that, we really have no idea how things are going to play out. However, time in the market has proven incredibly difficult to carry out successfully, especially given that oftentimes we see some of the strongest days of market performance following days of very weak market performance. So when you try to sell out before the drop, often that means you're going to miss out on those single day, very strong days of return. Yeah, I mean, those single day, very decent returns mean all the world to me when I'm looking at this one giant candle. We remember this a couple of weeks ago where the stock market went up 10% and everybody was like, oh my God, the bull market's back. This is so awesome, right? But lest we forget that the market was down. The market was down 19% at one point. And so now we're just back to down 10%. Huh. So how about we just sidestep that, completely eliminate the fact that the market went down 20% and then went up 10%. And then you've just been in cash that entire time. Well, what are you talking about, Chris? There's no possible way. There's no possible way that you could know where that is, Chris. Dude, I'm telling you right now, put your 10 over the 20, price over the 50. That's a bullish trend. Do the opposite. That's a bearish trend. If trend is down, no holdy stocky. Okay. If trend is up, holdy stocky until it reverses. Bro, you're smart enough to know this. And missing just 10 of these individual.
This is so fucking stupid. I get so mad at these charts. If you miss the 10 best days of the year, you're going to be losing so much money. Bro, a 10% up move was a giant move. And if I had not taken that move, I'm pretty sure I'd still have more money in my account getting out up here with the red light than hoping and praying to God things are going to come back and having this one candle. I hate these charts. I loathe these charts, right? This is the stupid BS that people want to push on you and say, oh, just hold the market whenever it goes up and whenever it goes down. It's going to go up forever, right? Bro, just get out of the way. Let the market come down. Once it bottoms, get back in. Is it really that hard?
Individual high return days can dramatically drag down the return experience as an investor. So it's usually not worth the risk of missing the strong days to try and sidestep what's historically proven to be temporary downturns. And while safe assets might continue to do well, buying into things like gold, for example, after they've appreciated in price means you're paying a premium for these assets. So
I would love to pay as much as I possibly could for gold because gold is amazing. I think gold is probably the very best stock or investment or any other thing that you could possibly put your money in, except for me, because I am a genius. If only everything else went like this. This is how it looked like whenever people were voting for me against Joe Biden. You could see from across the world that I was going to win tremendously. And then Kamala Harris decided to show up and I did absolutely destroy. I beat Joe Biden and I beat Kamala. And because of that, I am a genius. And gold has gone up because of me, because everybody wants to own gold, because I am the man who's covered in gold. I am Midas himself. All right. With that being said, don't you want to own this? Oh my gosh, I want to own this. I want to own gold. Like, I want to own, hang on. That's the wrong button. I want to own gold so much if it's moving like this. Now, granted, I did not trade gold because it didn't fit my trading plan. But I would love to own gold as it's going up and 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 up. Who the frick wouldn't want to own gold as it's going up and up and up and up and up and up and up? Seriously? Are you telling me this is a bad thing? Are you telling me that when the price of an asset, be it gold, be it stocks, be it mutual funds, be it whatever, is going up like this, you're telling me that's the wrong time to be owning it? You have a CFA and you're telling me that this is a terrible investment. Are we looking at the same chart here? Do we have the same? Clearly, my itty bitty baby brain don't understand what you were talking about here, my friend, Mr. Plain Bagel. Holy but goodness, this is ridiculous.
Into things like gold, for example, after they've appreciated in price means you're paying a premium for these assets. So trying to reconcile the first two TikToks here, you don't want to be overly optimistic. You don't want to be reckless and assume that because we've seen a dip, things are going to bounce back up. There's a chance that things go lower in 2025, possibly even into 2026, given the severity of the trade war we're experiencing. However, if you are taking a long-term approach, you're being diligent with the risk you're taking on. You're not just throwing all your money in meme coins, assuming that over time they'll do well. You're aware of the risks your investments face and say the tariff exposure you have, and you have the risk tolerance to be investing, which is an important one. Then over the long term, you should likely do well by investing, even if you don't perfectly time the bottom. So hopefully that makes sense. We really don't know what the rest of the year is going to look like. So given that we can't predict the short term, it usually makes sense to focus on that longer term. Anyway, let's go back to taking notes here. Just thought I'd add some on these kind of conflicting ones.
Everyone thinks Trump's tariffs are about the trade war with China or Europe, but they are not. They're about crashing the US economy on purpose, and here's why. The US has to refinance $9 trillion in debt by 2026. Most of that was issued when interest rates were near zero. But today, the 10-year treasury yield is at 4.2%, and every single basis point adds billions in interest over time. So how do you bring yields down? Well, you slow down the economy, even if it hurts. And yes, tariffs usually push inflation up in the short term, but this isn't about the short term. This is about engineering a recession to bring yields down. It's not a trade war, it's a yield war. It's about refinancing America at a discount. So next time you see the headline about the trade war, actually watch the 10-year treasury yield, because this is where the real story is being written.
Well, if that was a plan, hasn't gone well so far. We've actually seen the 10-year treasury increase.
That's interesting. Now, I would completely disagree with what that person's saying, because Trump is a scoreboard guy. Politics aside, and don't come at me at politics, right? I've already got enough people saying, don't talk politics. Politics are driving the markets these days. Let's be very honest here. The reason the market looks like this is because Trump decided to tweet some stuff about the trade wars. And then he's like, China was so stupid. They should have listened to everything that I said, and we wouldn't even had a trade war, right? He is a scoreboard guy. This is not good for him. This is not good for him. And the last thing that Trump would want is for a 2008 style recession to come through, because that would be attached to his name and to his legacy. That's the last thing he wants to do. In fact, I would venture to say Trump will do anything and everything to make sure the stock market goes up, just like he did the first time, because he is, I'm a winner. Do not associate me with losing, just like Joe Biden, right? So, point being, if you're going to put politics into your trading plan, I actually think Trump is great. I think Trump is great because he wants the market to go up. If you are a lifelong, dyed in the hair and in your blood, blue Democrat, you do you. But we can both agree that there is no way that Donald J. Trump wants the market to go down and to be tied to a legacy of a failing stock market or in a failing economy. Just putting that out there.
Since the trade war kind of onset. So the TikTok is right that the US government needs to refinance a bunch of debt. There is concerns that the average interest rate, or effective interest rate rather, will increase because rates are being reset at a higher level. It is generally true that during a recession, we see treasury yields decrease because oftentimes we see investors put their money into treasuries as a safe haven investment to kind of sit on the sidelines and wait for the turbulence to pass. And the action of buying bonds decreases the yield, which lowers interest rates in the economy. Now, I don't know if that was Trump's plan with all this. That's kind of speculation. But there are two things I would sort of poke holes in that if that was the idea. The first being that while a recession might decrease the effective interest rate, it also likely increases how much money the government will have to borrow, because a recession will A, decrease tax revenue. If companies are making less money, that translates into less taxes paid to the government. And B, governments will likely have to spend more for fiscal stimulus. So you're both decreasing how much money you're bringing in, increasing how much money you're outlaying. That difference is made up by borrowing more money. In fact, historically, the biggest jumps we've seen in government debt have been during past recessions and crises. So that's the first thing. I don't know if the benefit of lowering the yield would offset the cost of this additional debt. The second thing is, like I mentioned, if that was a plan, it sort of backfired, given that we've actually seen a sell-off in the treasury bond market recently. Now, even here, people are speculating as to why people are selling treasury bonds. Some blame foreign entities selling in retaliation to Trump's tariffs. But there's also the view that investors just aren't treating treasury bonds as much of a safe haven and view it as being a bit riskier than it's been in the past, given how volatile government policy has been throughout all this. And if we see a hit to a government's creditworthiness, it can increase the risk premium that investors demand, which will actually raise yields. And while certainly not apples to apples comparison, I want to be very clear with that. We can look to Greece for an example of that, where following its sort of financial troubles after 2008, even with a severe drop in its economic activity, we still saw interest rates increase for the country. So I've seen this story before. Maybe that's one of the objectives here, but just kind of some interesting points to add to it.
The biggest mistake a lot of stock market beginners already made with this market drop is buying their stock all at once. Oh, the market's down. Let me put all my money in now. Buy the dip. You never want to buy all your stock all at once, because you don't know if the market's going to go up tomorrow or down, up next week, down next week. You want to slowly buy in small quantities, little by little. It's called dollar cost averaging. Buy a little bit each week or each day when the market is down, and continue buying. Don't just funnel in your money all at one point. If you put all your money in just because the market was down one day, then what happens the next day when the market dips even more? You have no money left to put in. You should ask yourself at the beginning of the day or when the market's open, is this a buying day? And then put a small percent of your money towards the stock that you wanted to buy when the price is down.
So yeah, dollar cost averaging.
Yeah, that one's not so bad. But again, right? Wait for the stock to come back up rather than the stock to come back down, right? AMD. I always go back to AMD because this was one when I first figured out how the YouTube algorithm works in early January. Everybody was screaming by AMD. January 6th was when I figured out what I was doing. January 6th, it was $122. Since January 6th, the price of AMD has gone down 25%. Down 25%. And sure, you can add all the way down. By all means, buy as much as you can all the way down. But I will do the opposite. I will be buying on its way up. Remove one drawing. There we go. Still getting used to this. I will be buying as it's going up if it fits my trading plan. And I actually will buy my entire position all at once. I will buy, let's say if I'm going to do 10% of my portfolio size in any trade, I will buy that entire bit at once. Now, why would I do that? If I find a stock that's working, and I'm going to go to one that I know it's been pretty well lately, Coca-Cola, right? Let's say, for example, that I bought Coke, and I did not, and I'm not saying that I would have, and I'm not calling myself a genius or anything like that, but let's do some red light, green light. If I bought all of it right here, and then it went up, right? We had our 10, 20, 50 cross. In fact, actually would have been a little bit better than that. So red light, green light means your 10 is over the 20, price is over the 50, and then price closes over your 10. So 10, 20, 50 is crossed up, price closes over the 10. That's your green light. And then I wait for a red light where it closes under the 10 EMA. Red light right here. I could have dollar cost averaged all the way up into this. Of course, I could have. But by getting my entire boat in at this candle and then out at this candle, I've made way more money. That's a 10% move in the span of a few days. So I've been able to take a huge move just like that with my entire position, rather than, oh, I'm going to do a couple percent here, a couple percent here, I'm going to layer into this as it goes up. No. Now, the opposite would be true for something like, let's go to AMD, right? And this is why it's so important to have your risk in check. Because let's say I got in right here, the 10, 20, 50 crossed over. Let's say I got in on this candle. And then I had to get back out on this candle right here. Yeah, I would have lost, but I would have lost small. By going in with your full position size, you can win big, but still lose small because you know where you're going to get out, right? If you know where you're going to get out, that makes all the difference in the world. This was a question that came through talking about half an ATR. So for me, when I get into a trade, I get in at, let's say I get in at 100, half an ATR below that. ATR is the average true range. This is the volatility of the stock. When the volatility of a stock expands, your ATR expands, which means you take a smaller position with a larger stop loss. But if your volatility is small, you can take a larger position with a smaller stop loss, right? Anytime volatility expands, you need to trade smaller, okay? Now, for me, the question was, you mentioned that you have a stop loss at a half ATR. That's great, but how do you convert that to option pricing? For buying calls, that's simple. But what about spreads? I don't do spreads, bro. I see no reason at all to do spreads. In fact, let's do an example of what an option spread is. In fact, hang on. I saw this in TradingView just yesterday. Let's do a spread. Cool. All right, bull call spread. Great strategy. Save. There we go. Bull call spread. Let's say that I have a bull call spread here. Now, if I were to buy the stock, or I should say buy a long call, the difference in a long call is that it will continue on forever up in the future, right? It'll go like up there. I don't have a limit to my gain. By doing a spread, I have artificially capped my gains. That's lame. Why would I ever want to do that, right? And I mean, I didn't really set this one up in any particular way. I just took the first one that was on here. But on a spread, you limit your losses, but you also limit your gains. On a long call, on a deep in the money long call, you limit your losses, but you have unlimited gains. Big difference there. So to Katie's question, for buying calls, it's simple. What about spreads? I mean, for me, the price of the underlying option is going to be what it's going to be whenever I get in and when I get out. And I don't stress too much on that, right? If the price of the stock is going up, the price of my option is going up by about 80% of that, right? Because at an 80 delta, which is where I go, for every $1 move in the stock, it moves 80 cents. So if the stock moves $10, my option goes up $8. And if I've only spent $2 on that option, I have quadrupled my money, quintupled my money. It went from $2 up to 10 because I had an $8 profit. Pretty sweet, right? So that's how I feel. Limit your losses, of course, but let your winners run out of control. And most people can't do this.
Is a really popular approach for investing, whereby you take the same amount of money, let's say $100 or $500 a month, and you invest it into the market in regular intervals, so that you're always buying. And what that does is that if prices fall lower, you end up lowering your cost basis, meaning you're buying more shares for less money, which is generally a good thing if you assume that stock is going to increase in price. And if market
First off, let's break down him trying to explain dollar cost averaging, why it's a good thing.
amount of money, let's say $100 or $500 a month, and you invest it into the market in regular intervals, so that you're always buying. And what that does is that if prices fall lower, you end up lowering your cost basis, meaning you're buying more shares for less money.
Right. Lowering your cost basis, going back to this perfect example, right? You're lowering your cost basis, right? Each time, let's do this. Let's do an average equals average, and we're going to lock the top cell, but not lock the bottom cell. So what this does is it shows us our average price as we go down, okay? And let's say it goes down to 90, just so we can get a couple more examples here. Insert so it gets out of the way. All right, so we started at 145 on this on AMD, and now we average down by buying more at 130. Cool. Now our average price is 137. And then we bought more at 115. So our average price, is 130. And then we add more at 97. So our average price is at 121. And then we average more at 90. Okay. So here's the deal. When the stock is at 130, your average price was 137. When the stock is at 115, your average price is 130. When the stock is at 97, your average price is at 121. When the average price is at 90, or when the stock's at 90, your average price is 115. So what is the difference there? In fact, let's do this on the fly. So it equals this minus this. Right. So this shows you how much of a loser you are per share. Oh, wow. It actually gets worse. I didn't realize that. It actually gets worse. Holy cow. That was unexpected. I didn't realize the math was going to math out like that. You buy at 145, you buy at 130, buy at 115, buy at 97, buy at 90, thinking that, hey, you know what? I am a true genius in dollar cost averaging. Look at this. I have dollar cost averaged my way all the way down to 115. But the spread between what the actual price is and your average cost has gotten wider and wider and wider each time you've done that. And you want to tell me that this is what you should be doing. You're a loser already by this point. And you've bought more, and you bought more, and you bought more. So you're losing on top of losing on top of losing. That would be what one of my mentors would say. There is no shame in losing money on a stock trade, but to hold on to a loss and let it get bigger and bigger, or even worse, to buy more is amateurish and self-destructive. Dollar cost averaging on the way up is how it's done. Dollar cost averaging on the way down, you're digging a hole deeper and deeper and deeper and hoping one day that you can crawl out of it. Sorry, it's just the facts.
Which is generally a good thing if you assume that stock is going to increase in price. And if markets are increasing, you're not sitting on the sidelines, right? You're still buying on the chance that stocks continue to increase. The problem with this comparison is that whether DCAing or lump sum investing is superior depends on where stocks move in the short term, and we don't know what that's going to be, right? In this example, he says, what if you buy a bit today and then stocks fall lower tomorrow? You'll regret not DCAing. But I could flip that argument and say, what if you buy today and then stock prices skyrocket tomorrow? You would regret not lump sum investing. So naturally, the better approach will depend on where markets move, and we can't predict that.
We can't predict that. That's true. But we can get we can get an idea of which direction they're going, right? We can get an idea of which direction they're moving. And you want to be moving in the direction that they're going.
And historically, lump sum investing has actually had a better chance of earning
Let's go. That's what I do.
you a slightly better return versus dollar cost averaging. The problem is that most people are forced to dollar cost average because you aren't paid your lifetime salary all at once. So you can't lump sum invest your entire life savings. So you have to invest on a recurring basis.
And I would definitely not say lump sum invest your entire life savings into anything. That's a terrible idea. That's some hot baloney right there. I would say find what risk to your portfolio you're willing to take, and then put that into an individual stock if it sets up for your trading plan. Okay? If it sets up for you, take a position, but not your entire portfolio, and let that position work. If it doesn't work, you get out. And then your others can continue to work. Let's say you have 10 positions on and 2 don't work out. Okay, now you have 8 positions on and they're working. This is something that I realized when I started making money in the markets. This was actually pretty fun. I would log in every day and I would just see winners on the board, right? I would log in every day and I'd see winner after winner. How often do you log into your portfolio, into your broker account, and see winner after winner? Probably not that often. Probably not that often. Now, the reason being is that we as humans, we want to hope and pray that the stock we bought comes back. We as human beings don't want to admit we're wrong. We definitely don't want to lose money. That sucks. That sucks in both directions. But when you have, let's say 10, and you lop off the 2 that aren't working, you keep 8 winners, and you keep those 8 winners as long as they're working. And then you can look for 2 more trades. And then if they work, maybe you've got a 9th one that stays on. Maybe you've got a 10th one that stays on. And if you're logging into your broker platform and you're just surrounded by red, you're doing it wrong. If you're logging into your platform and all you see are winners, it means you're doing it right. It means you're picking good stocks and you're holding on to those stocks and letting them work for you. And I'm telling you right now, I think it's actually harder to let a stock run that's working for you than to cut a loser short. And what do I mean by that? Like, let's say if I bought a stock at 100 and it goes up to 105, 110, You're probably sitting there like, ooh, I've got to take my money right now. I need my money. I need my money. But there's no reason to get out. Oh, I need my money right now. I got to have it. I got to have it. And you take it out. And then the stock goes up to 120, 130, 150, 170. And you're like, if I had only not been so greedy and let this trade that I didn't have to do anything with go from 100 to 170, but I couldn't sit on those open winners. I had to take that money off the table. I personally think that that is much harder to do. Let your trades work. Let them continue to run as far as they possibly can than to take that loss. That's why most people aren't successful in the markets. I've had to overcome my own demons. It's time for you to overcome yours. Let's get back to the video.
Which isn't inherently bad. In fact, kind of the benefit of dollar cost averaging is the psychological benefit or behavioral benefit of keeping your money invested and following a stringent approach. And that can make it easier to invest because it automates the process. You're more willing to invest during market downturns because it's just part of the process. It sort of removes some of the decision. And generally, you can still do very well with dollar cost averaging. But if you assume that markets are going to increase in the long term and you aren't trying to predict the short term, then lump sum investing actually makes more sense. Now, that's not a guarantee, right? In this current situation, it might prove that dollar cost averaging makes more sense than, say, investing all today if things do fall lower. It's just to highlight that doesn't inherently make more sense than lump sum investing because it's situation specific, right? It depends on how markets perform. But I'm forgetting my role here. Dollar cost average on buy days. Thanks, TikTok.
When you don't pay taxes, a lot of these types of purchases start to become a little bit different.
So you don't pay taxes?
Oh, no, I don't pay any taxes.
Why is that?
This is you. This is your company. Profits in the company create taxes.
Okay, here's the deal. I just recently learned this year of a lot of tax strategies that I wish I had known about for years. I am a business owner, and I'm telling you, first off, this is not tax advice, but this is Chris advice. If you can start a business in some way, it behooves you to do so. If you can figure out these tax loopholes that you can get as a business owner, it behooves you to do so. Now, granted, I don't know all of them, but I definitely am going to be learning them. And I'm going to be having a conversation with a tax strategist to make sure that I completely max this out. But this is something you really, really should start trying to put in your life. I'm telling you, this makes a huge difference.
So what we need to do is eliminate the profit. How you do that is your company creates a holding company and transfers the profit here. This holding company then buys an appreciating asset that you can take loans against. The purpose of the holding company is to make sure that when the loans are taken, it can take care of the company's business expenses, the purchase of business assets, payroll, and all things related to the business. Because we're using loans to then come back out to take care of you, we create no taxes because loans are not taxable. Then the income comes back into the business and we create the entire cycle again, which creates no taxes. So if you still have questions, comment below. Taxes.
Start a company, don't pay taxes.
Hold on. Of course, he's being sarcastic here, which I appreciate. Do your research. I am not a tax advisor. I am not a tax strategist. And like I said, it took me years to figure out deductions that I could have had for years. And I feel so stupid only having learned them for the taxes that I just finished up that I could have had for years by now. But the tax system actually does some really, really cool things if you know how to work it. But then again, do not try to, I shouldn't be giving any sort of tax advice. My advice to you is find somebody who knows what they're talking about, not me.
It's crazy how many TikTok videos seem to suggest that you can buy a fancy sports car and then use it as a tax deduction to avoid paying taxes. There might be a situation where, say, you rent a car and use it for a marketing video or something and you expense that amount. The tax authority cares about your expense deductions being reasonable. So if you buy a personal use sports vehicle and then try to claim it as an expense and then you get audited, there's going to be a problem if you can't justify why you needed to buy the sports car for your business. The second thing, while I'm not a US tax expert, putting money through a company before you receive it doesn't eliminate taxes. You would pay taxes here when the company first receives money, that the corporation would pay tax on that. And then you would pay taxes here when you receive it personally as income. The tax authority doesn't care.
Well, I think where he's going with this is that it's not taxable income, it's loans, and you don't pay taxes on loans. So loan distributions versus a taxable W-2 1099 income. I think that's what he was trying to say in the video, but I have no idea what I'm talking about. Don't listen to me. I'm just a random guy.
That the company took out debt to pay you. There's still a tax liability that comes from that payment. Now, if you're literally taking a loan from your company, something called a shareholder loan, where you intend to pay the amount back and you're paying interest to the company, which is taxable, then while you're borrowing the money, yes, you wouldn't see income tax. But the point is, you can't just eliminate taxes through this complicated structure. You can delay taxes through some methods, and you can deduct actual expenses against your income to reduce your tax liability. But if you're investing your money in an appreciating asset, except for certain situations around depreciation and the like, you're certainly not going to be able to deduct that full cost of that thing you bought. And you'll likely run into issues if you try to deduct any of it if it's appreciating in value, right? Because that would be deemed an investment, not an expense. Now, there are strategies you can use to delay the taxes owed on investments, such as the appreciating asset like the video highlights, by taking a loan against it rather than selling, because if you sell an asset for more than you bought it for, that accrues taxes. So you do see, for example, billionaires borrowing against their investments rather than selling to, again, delay the taxes. They're not eliminating it, they're just delaying the tax until they eventually sell. But then at that point, you have to do the trade-off cost-benefit analysis between the benefit of delaying the tax expense to the real new cost that you're now accruing, which is the interest expense on that loan. And unless you're a billionaire where the vast majority of your wealth is tied up in stock options that you were awarded, decades ago, and you're in the highest tax bracket, it's probably not going to be that beneficial. I mean, if you have questions about taxes, don't leave a comment. Reach out to a professional, someone who can tell you with authority what you can and can't deduct. Because yes, there are.
This is the thing I can agree with most. Find somebody who knows what they're talking about.
Benefits if you are incorporated to deducting certain expenses, right? If you take a business trip, it makes sense that you deduct your that from your income, so you can see a benefit there. But if you get audited and they find out that you've just been deducting everything and luxury car purchases, there's going to be trouble. I'll add a quick tag saying this one might be legal, but moving on.
So are we just supposed to ignore all these giant dips that happened during President Biden era? Just to paint the picture a little more clear, this is how much we lost during President Biden. Over 20%. This is how much the Dow Jones has crashed as of today. But the difference between this and that is that during Biden was just being Biden. And all these dips happened with no progress in the economy being made for basically the entirety of his presidency. And yes, the stock market is going on a bit of a correction, but this time there's a purpose. President Trump has already stated that this is on purpose. Remember when he said short-term pain for long-term gain? The reason why he put in these tariffs is not just to show the world a lesson and to be fair. Yes, that's a part of it. But the main purpose is to get the money that was exploited by other countries back into the US. For example, this candle. Let's say this candle is made by China and this candle cost $20. 5 of those dollars stay in the US and the remaining 15 go to China. Now with these tariffs, this same candle costs $30. But then we have this American-made candle that costs $25. And very obviously, you're going to pay for the candle that costs less. But the difference between buying this $30 candle and this $25 candle is when you buy the cheaper $25 candle, the whole $25 stays in the US economy, causing more money to circulate around. Be honest with yourself. If tariffs are so bad and directly impact the consumer mainly, why do countries care so much? Everybody's losing their mind over this when all this madness was happening, not a word was said.
So look, I don't care about Trump versus Biden. I'm Canadian. I didn't vote for either of them. The dips during Biden's time, there was a reason for it. It was monetary tightening. We were seeing interest rates increase and quantitative tightening. Those are things that generally weigh on the stock market. But two, mainly on the topic of tariffs. Personally, I'm an advocate for free trade, but I'll acknowledge it's a tricky area and countries do have to manage through trade policy to consider consequences, right? For example, things around national defense. Things where another country is heavily subsidizing an industry. But a big criticism of all this has been, the volatility of it, how quickly things have changed, that reduces faith in the US economy and faith in its ability as a trade partner, and how severe and wide stretching it's been. One of the criticisms, for example, is that while these tariffs are being presented as a way of bringing jobs back to the United States, for one, it doesn't ensure that 100% of the proceeds a company makes will stay in the US like the poster suggests. If the manufacturer is owned by foreign entities, we'll still likely see those profits sent elsewhere. And two, the US already has an incredibly strong labor market. Yes, it's in different areas other than manufacturing, but these are highly coveted areas like technology and defense, things of that sort. And when you factor in things like reciprocal tariffs, it's unlikely that we see a net benefit from this trade war persisting. It's going to take many, many years for companies to onshore some of their production, assuming that they survive long enough to do so, and households will ultimately bear the costs. Budget Lab at Yale estimates that households will see an average cost increase of $4,900 a year, or around $2,200 for lower income households, and that gross domestic product growth will decrease. With the World Trade Organization even arguing that global GDP could see a 7% hit from China and the US maintaining its current trade war. And just generally, the mainstream economic view has long been that free trade benefits all parties. And yes, there are considerations. We don't want to oversimplify. We have to consider capital flows. We have to consider employment and things of that sort. But if the US is able to import a commodity for cheaper than what it can make it domestically because of things like specialization and economies of scale, and use its advanced expertise in other areas that it's specialized in to turn those into even more valuable products and services kind of being a big one, then that's not a bad deal per se. And we've also seen historically that isolationism, where country A tries to do everything themselves and B shuts out trade partners, it can be detrimental to an economy. Take the candle example. The country is effectively hamstringing artificial intelligence development to make more candles. Time will tell how things turn out, but generally speaking, I do believe the current tariff policy adds more friction than it benefits the US economy. Again, there are issues that need to be addressed. I don't think this is the right approach.
Girl math is opening a brand new LLC for $200, then applying for 50K 0% interest.
Oh, yikes. I've seen these before. Anytime you see something like open a LLC and then get so much of business interest and then never pay for it because you'll just close the company. Okay, that is straight up fraud. Don't even, no way, Jose, should you even try and do anything like this. Like, before this gets 10 seconds into it, if you ever see something like this, immediately swipe away so the TikTok algorithm doesn't send this to you again. This is straight up illegal. This is straight up someone's going to jail. Surely. And then to go brag about it on social media, goodness gravy.
Business funding, then using it to invest in your first Airbnb property for 10K, then paying off the funding with the profits from Airbnb.
Oh, it's a credit card. Oh. I don't know if this checks out. Buy $60,000 Airbnb on credit card, pay off mortgage.
Okay. Different than what I thought it was going to say, because I have seen several of them where it's like this kid in the pool and he's like, oh, I have like 7 LLCs and each one of them I get a $20,000 credit card. And then I go buy Rolexes and I go do my own lifestyle. And then I just never pay them. I don't care. What are they going to do? Take out the business? I don't even have anything in the business. Who cares? Bro, that is straight up theft. Okay. This one, do you actually think you can, first off, do you actually think you're going to get a credit limit for $60,000 on a business with absolutely no income? Not going to happen. Second off, do you actually think that you could buy an Airbnb? What Airbnb in the world that's outside of like, Flavella in, an ultra scary place could you buy for $60,000? And 3, do you actually think that people will rent that Flavella from you so that they can go on their luxury vacations to your Flavella in the scary neighborhood so you can pay off your credit card? It's never going to happen, right? This idea is never going to happen.
I don't know what it is with finance TikToks, but somehow opening a corporation or starting a company is like apparently the finance cheat code. It just solves all your problems. Like, you don't want to pay taxes? Easy. Open a holding company. You want people to start giving you free money? Simple. Start an LLC. You want to buy a $60,000 Airbnb that pays itself off before your 0% promotion ends on your credit card? Buy my course. Either there's an important detail being left out here, or it just isn't true. You're not going to get a property for $60,000 if it's that profitable of an Airbnb. And while there are interest rate promotions you might see like this, they're usually pretty short term. So you have to refinance into a mortgage within a few months before you end up paying a 20+% credit card rate. Yeah, we'll end on that one. So kind of forgot to take notes on everything, but here we are. We have our list of takeaways here. I think it was pretty insightful. And, we're kind of poking fun at some stuff here, but as I always trying to highlight, there are some great TikToks out there, some great videos that give you helpful information. You can learn a lot about the basics and the like online. But hopefully this shows there's also a lot of conflicting information and stuff you have to be very cautious about. And if it's going to impact your financial decision, you're better reaching out to a financial advisor. You can get to know
For sure. That was a cool video. I like watching people react to finance TikToks. I don't know if you do, but I think there's a lot of good information, right? So let's do this. Let's shift gears a little bit and let's see what the market is telling us. So first off, whenever we look and see what the market is telling us, this is what I'm looking at. This is the master key. Now, when the master key is lit up, I have had tremendous success rates trading stocks. And it starts with the outlier buy signal on the SPY, which we have a buy signal on the SPY as of April 25th, if you can believe this. So that gives me a lot of encouragement, along with the fact that the market seems to have bottomed. As I mentioned a couple times, we do have this buy signal here. Now, a couple of things right here. Outlier has an overhead order block. TradingView also has one up here around 580, but we got some room. Additionally, what I wanted to point out here was the fear has been evaporating out of the S&P. Now, this level here, so this is the SPY fear and greed on the asset itself. This is the average of the 500 stocks in the S&P 500. They also, on average, are getting less fearful moving towards greed. That's exactly what you want to see when you are looking to buy any stock. Next is the market trend. We don't quite have that crossover yet, but mathematically speaking, if we close over 555, really confident that that comes through tomorrow. If we can close over 555, the moving averages should mathematically cross over. Next, market breadth. Market breadth, as I mentioned earlier, has gone up real hard, real fast. Let me go back to the full stocks. So this is all the stocks that we cover. And it went up super fast. It went from 1% of stocks on the bull list to now over 75% on the bull list in just a couple of weeks. A move up like that is encouraging, but also I could totally see people taking money off the table and maybe a contraction pulling right back. So this is definitely still a very risky market. But the sector breadth, if we look at this, all the sectors are still bullish. All of them are still bullish, but staples seems to be weakening bullish. Interesting. To Deep Thought's point, elastic band theory. The further it goes in one direction, the more likely it is to snap back. So let's look at a couple things. I saw somebody asking to look at SoFi. Tactical Gamer wants to look at SoFi. So first off, I would say I'm not buying anything yet in the market, but it's close. So trend of the SPY aside, let's look at SoFi. This one here, SoFi. And we can see over here right now, SoFi is sitting on a buy signal. Doesn't quite have, let me go to the 3-month timeline. Doesn't quite have, where'd that buy signal go? Oh, there it is. Doesn't quite have the 10, 20, 50 crossed over. Oh my, hang on, let's see. Let me look in trading view. SoFi. Okay, so this is crossed over as of today. Now, there are some areas of order blocks on top of this, which is something I'm seeing right here too. Order blocks are large institutional orders waiting to get filled. And if you decide to buy with an order block staring you right in the face, you might be looking at what happened up here, and maybe a third time where it went up to that area and got rejected. Went up to that area, got rejected. So we'll have to see what plays out here. But it is getting less fearful, more greedy. The financials sector on average is getting less fearful as well. That's what you want to see. So if you take a bite into SoFi, just be sure to keep your risk in check. Be sure to keep your risk in check. Let's see. There was another question came through. How often are your exits lower than planned? Let's say current price 2 ATR because the golden toilet dropped to 90 at the end of the day. So that happens, right? Stocks can absolutely gap down through where you want to get out. So for example, let's say that I was buying SoFi at, let's say I was buying SoFi at 1323. And then I'm still getting used to trading view. I want it to be visual order bring to front so we can always see it. Okay. So let's say we buy it here, and a half an ATR is, get out of the way here. So the ATR value right now is at 86 cents. So we say 13.25 minus, can I do this? No, I can't do that. Hang on. So we do 0.86 divided by 2. There we go, 43 cents. So 13.23 minus 0.43 equals 1280. So half an ATR down from there would be 1280. 1280. Right there. So can this gap down through here? Absolutely it can. Any stock can do that. And I've told y'all this a million times. All stocks are bad. Where's my arrows? All stocks are bad, but every once in a while they act right, right? Imagine it goes down through there. Totally could happen. Now, what will save you? The only thing that you have control over once you're in the market is how big your position size is, right? If you're going 1,000 shares into SoFi, when really you're comfortable with 100 shares, so you have 10 times more exposure than you would have normally, probably not the best choice, right? Probably not the best choice. So, of course, how big of a position should you have? Well, that's up to you. What I would encourage you to do is use this formula. Once I find the slide for it, what I would encourage you to do is use this formula. take your account balance and multiply it by the risk you're willing to take. So for example, the risk being, if you have a $100,000 account, you're willing to risk 5,000. That's not portfolio size, that's risk. So if you're wrong, you still have 95,000 in your account. And then you divide that by 2 times the ATR. And the ATR, as I mentioned earlier, this is how much volatility you have. How much volatility you have. If you look back, July of 2024, volatility was at like 18 cents. Now volatility today is at 85 cents. So during that time, volatility has expanded, 5x, 6x, which means you need to be trading 5 or 6 times smaller than you did just a few months ago because the volatility has expanded so much. So that is my formula for position sizing. And honestly, once you're in the market, that's all you can do and know where you're going to get out. That's a great question. David asked, do you recommend setting trailing stop losses even if it has the potential to sell you out of a position before it officially crosses into a bearish trend? Absolutely, dude. With no hesitation whatsoever. Let's use SoFi here. And let's say that I'm using the 10 EMA as a trailing stop, which I do. Funny enough. That's one of my exit rules here. Half an ATR is my stop loss. The 10 EMA is my trailing stop. So let's say, for example, that I decided to get, actually, I just found this the other day. This replay button. This is so freaking cool. All right, check this out. Like I say, I'm new to TradingView, so I'm still learning things. Let's say that we bought SoFi as it crossed over the 10 EMA right there. So we're going to hit play and buy. And so we sell out and we're closed, right? That happens. And it closes back over and we buy again. Now we wait. We wait until it closes under that 10 EMA. This is such a cool tool. I was so excited to find this. We're waiting for it to cross under the 10 EMA to get out. Our trailing stop. You can see it's going up. Oh, it did not close under that. Did not close under it. Lots of order blocks here, but we're just following the 10 EMA. That's all we care about. Oh yeah, let's go, baby. To the moon. All right. Still looking good. 10 EMA, trailing stop, moving up along with us. Keep it going. At some point, it's got to come back, right? Wait. No, didn't under that. There it is, right there. That's our exit point. Stop. That was our exit point. So we went from, right, this small loss or whatever it was, small win, small loss. Sometimes you make a buck, sometimes you lose a buck. But when you're in the trade and you're in the trend, you absolutely want to use the trailing stop. As it went through that entire move right there, that was a 103% move that you would not have. You would not have without a trailing stop. And it didn't get into a bearish trend yet. It didn't, right? But what the red light, green light does is it tells you when things aren't going right. So I'm going to speed this up because I want to show you what I mean. The red light, green light tells you when something isn't working right versus, in fact, let me remove this. How do I remove this one drawing? I want this one to go away. There we go. It tells you when the market's not working in your favor versus when it is working in your favor. So right here, we're going to speed this up. And we've already seen the red light right here to get out. Watch what happens next. Goes up a little bit, comes down a little bit, goes sideways, goes down, now hits a bearish trend. At this point, this was a bearish trend, and I got a lot of hate from the SoFi bro saying, oh yeah, it can't be a bearish trend. It has to go up from here, stupid. You got your giant nose and your glasses and you're halfway bald. No, it has to go up. Yeah, whatever. And it did, but it ran into this order block, and then what happened? It has to go up from here. The CEO is going to make so much money. So wait a minute. It has, wait, stop. Wait, that's the wrong way. It has to go up from here. Oh, shoot. This has not gone well. Congrats, trader. Right. So when you use that trailing stop and you use the red light, green light theory, where if it goes over the 10 EMA and closes under the 10 EMA, it gets you out before all this baloney happens, right? All of this sideways and down movement happened after it closed under the 10 EMA one time. Does it mean it'll always happen like that? For sure not. But we can look at other examples. Let's look at Apple. Apple's a stock that at one point in time could never, ever, ever go down, right? Let's do that again. Let's do the replay Yes, we want to do the replay right. Let's do it right here as it's going down, right? Let's do the replay here as it's going down. Man, this is such a cool tool. I can really teach really, really good with this. Right? It's moving down. We don't want to buy that. That's too fast for me. That's too fast. That's too fast. Let's go to 3x. Okay, still moving down. Not interested. Still moving down. Nah, didn't quite get that crossover yet. Still moving down. Still, oh, here we go. Everything's crossed over. Okay, so stop. That would have been an exit signal. Red light right there. What I'm trying to tell you is that you're not going to get the top. You're not going to get the bottom. But if you can let the market tell you which direction it's going and listen, rather than you trying to tell it what it needs to do, listen to what it's telling you, you can take these nice moves right here. Now, of course, let's let it continue on. Oh, wait, wrong button. Let's let it continue on. Oh, shoot. Look at that. Let's go. Right. And this big move right here, this entire move is happening. Let me stop. This move's too fast for me. I'm gonna have to go slower. When it's moving up like this, you can make buttloads of money. And then when it crosses under the 10, you can get out of the way before the movement against you really starts to hurt. So pretty sweet, right? Pretty sweet. The problem is that this is the fact that people seem to look at you like you've arrived from Mars when you try to state facts. Yeah, for sure. I'm just trying to help you. I don't have to do this. I literally could do anything else in the world, but I choose to do this. When you buy more shares each time you DCA, instead of buying the same amount each time, could you buy 2x more? This is about to get real ugly. If you thought this was ugly, if you thought this dollar cost averaging was ugly, just wait. Just wait. All right. This is going to be fun. So let's say you buy 100 shares of each one of these. And you're like, well, at this point, every time it goes down, I'm going to add another 50. This is going to be really, really, really ugly, just so you know. Like ultra, ultra ugly. Now let's do equals this times this. Okay. And then divide by that per. No, that doesn't do anything. Hang on. I want to make sure I do this correctly because this is going to get really ugly really fast. Yeah, I need that. Then this. Okay. And then I need to sum this. Sum this. So this is this divided by this, right? Okay. And then I need to go this divided by the sum of these two and lock the top one. I need to do both of these. Yeah. That. Okay, that should work. Yeah, look at this. So now you've got even more as it's going down. You have put in, it's, I don't know if I worked this correctly. Yeah, now it's a $28 spread. I deleted it earlier, but now it's a $28 spread instead of a $21 spread or $18 spread. Point being, I did my math wrong. But the point is that as you're averaging down and adding more, in theory, it feels better, but in practice, you're digging a bigger and bigger and bigger hole. A bigger and bigger and bigger hole. So listen, we covered a lot today. I'm so stoked that I had the opportunity to hang with you this morning. This is my very favorite thing to do in the world. So I need you to do me a favor. Tell everybody you know about this channel so that they can watch, they can learn. And so as the market is going up, we can all profit together. So be sure to click one of these two videos that YouTube is recommending, and I'll see you on this afternoon's live stream.